gold that was true 3 months ago, but wasn't obvious is, there's a really major important new buyer come in, and that's Tether, which is, Tether, the big stablecoin company. So if you look at the last 2 quarters, that's the second quarter going all the way back to April, the second quarter and the third quarter, Tether purchased more gold, physical gold, than any other central bank. And by a meaningful margin, particularly in the third quarter, by a meaningful margin. So this is a significant new buyer with deep, deep pockets, right? I mean, remember the stablecoin, the US stablecoin, but they've been pocketing their 4% interest all the way along. So they have very deep pockets.
A major development that was not obvious just a few months ago is the emergence of Tether as a significant new buyer of physical gold. Over the second and third quarters, beginning in April, Tether reportedly purchased more gold than any single central bank, and by a wide margin in the third quarter. This marks a historic change in gold demand dynamics. Adrian, a respected global investment strategist, recently highlighted a quiet but powerful shift in the gold market. Tether, the world's largest stablecoin issuer, has accumulated enormous capital by earning interest on its US dollar reserves, giving it exceptionally deep pockets. Rather than relying solely on traditional assets, the company has increasingly turned to physical gold as a strategic reserve asset. As Adrian notes, this trend signals a broader shift where non-sovereign institutions are beginning to rival central banks in gold accumulation. For the global gold market, the rise of Tether as a buyer introduces a powerful new source of long-term demand that investors and policymakers can no longer ignore. Now, we present the clips from Adrian Day's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
Both on Bitcoin and on gold. And I think they're going to continue to be big buyers of gold. So when you see a new buyer, then we also have, of course, the central banks where the buying has come down a little bit from the highs last year, but it's still very, very high, and in fact picked up in the last quarter over the previous quarter. And it's very diverse. It's not just, for a long time, people just kept going on about China. It's not just China, as you know. It's Poland, it's Kazakhstan. It's, a whole bunch of countries are buying gold on a consistent basis. And the sentiment in the US, I think, is definitely beginning to turn, or in North America, is definitely beginning to turn, no question about that. It is still not in any way a flood of buying, and it's certainly far from sort of some kind of mania. We are not anywhere close to that at the moment. And so when people talk about gold being in a bubble, that's just nonsense, because you can't have a bubble without broad public participation, which we don't have. But sentiment is changing. And I think also as the Tether story gets better known, what Tether's doing, then that will probably bring a whole new group of buyers into gold. So no, I remain very, very positive on gold, very positive. And it's interesting. I heard Juan Santori, who's the head of special projects, I think they call it, for Tether, but he's the one that's really driving this gold, or in charge of this gold drive. He said their biggest issue, they have a gold stable coin now. You probably know that in addition to the US stable coin, the gold stable coin is far, far smaller. He said their biggest issue is actually making sure that they can get the steady supply of physical gold to back the stable coin, given the growth that they are expecting from that coin. Which is, he said they're looking at it to have the same kind of growth trajectory as the US stablecoin. And so they're doing all sorts of interesting things. One of the things they're doing, for example, they've approached several gold mining companies for offtake agreements. Now, we don't need to get into the weeds here, but I mean, I think with the gold market, there is much less reason, both for buyers, but also for the miners, to enter offtake agreements than there is in copper or zinc or, some of those other base metals and other resources, particularly the more illiquid ones like lithium and rare earths, where offtake agreements are essential. It's not true in gold because a producer can sell his gold anytime he wants at the market price. But nonetheless, that just illustrates the thinking on the part of Tether to try to get long-term supplies of gold.
Gold continues to strengthen as a long-term investment, and Adrian Day remains very positive on its outlook. Central bank buying has eased slightly from last year's highs, but is still historically strong and increasingly diversified, with countries like Poland, Kazakhstan, and others consistently adding gold, not just China. At the same time, sentiment in North America is clearly improving, though far from speculative mania, making claims of a gold bubble unrealistic. A key new factor is Tether's growing role as a major gold buyer through both reserves and its gold-backed stablecoin. As Tether's strategy becomes better known, it could attract a new group of institutional and private investors into the gold market. Let's get back to the interview.
A little bit concerned to varying degrees about dollar weaponization. How much is too much? I would argue if you're concerned about that, 48% is still too high. So I think you're going to see continued selling of the dollar, but obviously, as time goes on and the number goes down, that will slow. And you're going to see most of that dollar sales are going to go into gold. That's central banks are diversifying a little bit, but you look at how much they own in the euro, which is the next big asset. It's about 20% right now. Gold is more than the euro. But after the euro, what is there? There's some central banks that own a little bit of Japanese yen. There's one that owns a little bit of Australian dollar. But Saudi Arabia owns a little bit of silver. But basically, if you don't own gold, most of your reserves are going into, if you don't own the dollar, most of your reserves are going into gold. So yes, I agree with you. At some point, it'll slow down, but I think at that point, other people will take over. Retail tends not to be bottom fishers, but tends to be momentum buyers and price followers. I'm surprised that we haven't seen more interest yet, to be honest. I'm quite surprised we haven't seen more interest yet from Western countries. And, they look at Australia and say, oh, gold buying in Australia is up, gold buying in Canada is up. But if you look at it, and I don't mean to be, don't take this the wrong way, it's all Chinese and Asian people in Australia, in Canada. You look at the pictures of the lines outside the banks and the jewelry dealers. So Western buyers are really not in this market yet. And I think the reason for that is because the other assets are still doing well. If your brokerage statement month after month that's invested in plain vanilla S&P ETFs, but month after month it's going up, you don't really start looking around at other assets. If you look back at September 2011, yes, the arguments for gold were very, very strong. It looked like Europe was potentially falling apart, but there were the debt defaults or debt crisis, remember? And it looked like the whole European Union potentially could break up. So when you say what's different, and we never use those words, what's different this time, of course, the four most dangerous words in the investment lexicon is different this time. But there's no question that in 2011, although one could make a fundamental argument for gold, there was more speculative interest in gold back then. There had been more public interest in gold. So a couple of things. First of all, let's just look at price. If you look at if you look at the gold, price on a log chart, not on an arithmetic chart, you see that in the couple of years leading up to 2011, as well as incidentally in a couple of years leading up to 1980, which were both big major tops for gold, the run-up in gold ahead of 2011 was much, much stronger than the run-up we've seen in the last couple of years. We think of the last couple of years as being a great run-up, and it is, of course, because the price is $4,000. It's not $1,800 anymore. But in geometric terms, in log terms, it's nowhere near the sort of rally they had in 2011. That's number one. But number two, if you look at sentiment indicators, look at the GDX, for example, and you see that in 2011, starting at about April, you had a huge inflows, and I mean huge inflows into the GLD and the GDX, huge inflows into those sectors. You had both of those ETFs trading at premiums more days than not, and meaningful premiums. You know, when the GLD trades at a 1.5 or 2% premium, that is big for a physical entity. You haven't seen that this year. You've had a pickup of buying, but not a massive inflow by any means. And you certainly haven't seen those major, significant, ongoing premiums in the ETFs. So I think the sentiment was completely different back then. And that's what leads me to say that even though you can certainly look back at 2011 and say, yeah, this was a top for all these reasons, I don't think you can make the same reasons today.
Gold's current rally looks fundamentally different from past peaks, and Adrian Day argues the upside is far from over. Central banks continue reducing dollar exposure, with much of that diversification flowing directly into gold, since alternatives beyond the euro remain limited. While this selling will eventually slow, Day believes other buyers, particularly momentum-driven retail investors, will step in. Notably, Western investors remain largely absent as strong equity markets reduce urgency to diversify. Unlike 2011, today's gold price rise has been far less aggressive on a logarithmic basis, and ETF inflows and premiums remain muted. According to Adrian Day, weaker sentiment and limited public participation clearly show gold is not in a bubble. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos.